So I'd like to welcome to the show Doug Hoyes of Hoyes, McCallus and Associates, a licensed insolvency trustee. Doug tends to focus on helping individual people rather than corporations to rebuild their financial future. In addition to helping Canadians, he has appeared as an industry expert before the Senate Banking, Trade, and Commerce Committee and serves as an OSB, Office of the Superintendent of Bankruptcy, Oral Board Examiner. He also is an author and is interviewed very frequently by key media about insolvencies. I'd like to welcome to the show this afternoon, Doug Hoyes. Thanks for being here, Doug.
Thanks very much.
Excellent. Excellent. I thought we'd have start off with a general question. I think it's a question on the minds of investors. I get it all the time, and it's about the consumer themselves. And I guess what we're seeing now, and it's interesting pattern. Once upon a time, we wouldn't spend if we didn't have the money. And I think over the last, I guess now, decade or even longer, we're noticing that individuals, even though they may not have the money to spend, they're doing so quite frequently. At one point, I think we were spending $1.60 for every dollar we made on average in Canada. The last number I saw recently was up to $1.85 for every dollar that we make. And so I guess my first question to you is, how long can the consumer continue to spend if they're just not making the money? How long can they use the plastic, use the Visa cards? Are we starting to see cracks in consumer spending?
I think we are. And if you had asked me that question 5 years ago, I would have said, I don't know, maybe another year. And here we are. How far can you blow up the balloon? I don't know. We'll know when it pops, I guess. I think what's happening now is more and more people are hitting that limit. So you can see it in the number of personal insolvencies filed. As you said, the debt levels have certainly gone up. It's not just the debt level, though. It's the ability to service that debt. So 2 years ago, when interest rates were really low, wasn't so big a deal. I could have $1 million mortgage if it's a 2% mortgage rate, no big deal. But now that rates are a lot higher, we are getting a lot closer to the wall. So I think the answer to your question is more and more people are hitting the wall every day.
And so you mentioned businesses and consumer. Obviously, there are business insolvencies, consumer insolvencies. We've seen business insolvencies in 2023 spike 41.5%. I believe, if I'm not mistaken, that's a 3-decade high. We haven't seen that kind of number in a long time. Consumer insolvencies were up 23%. Why do you think there was such a dramatic spike last year among businesses, amongst consumers? Is it just I guess the idea or the notion that interest rates are higher, people with mortgages are carrying obviously a larger debt, and so with interest rates rising, these people are struggling? Is that the main reason why we've seen such a spike, especially on the consumer side?
It is, but we're also going off a lower base, right? So during, 2020, 2021, the number of insolvencies went way down because, hey, I'm not working. Nobody can sue me. They can't garnish my wages, so I don't have to file a bankruptcy or a consumer proposal to alleviate that. So when you're starting from a low number, any increase looks big. If you look at December 2023, which is the most recent personal insolvency stats we have, it's still slightly lower than the number of filings in December of 2019. So we are not yet back in Ontario anyways until that to that pre-pandemic level. Now, the businesses are even more interesting because you're right, there was a 41% increase in business insolvencies last year, but the total number of business insolvencies in Canada was something like 4,000, 5,000 insolvencies. So it's not a massive number when you compare it to the well over 100,000 insolvencies for people. But what concerns me is most businesses that cease to exist don't go bankrupt. They just go out of business. So you think of a hair salon, a barber shop, a restaurant. The shutdown happened. They were shut down for many months, and then business resumed. But a lot of them, you didn't go back and get 9 haircuts the day your barber reopened. They've lost that permanent amount of revenue. And they've got a bunch of debt. A lot of them have SEBA loans, for example, but they don't file bankruptcy. They just shut their doors and say to the landlord, look, here's the keys. You do what you want. And the landlord says, oh, well, if you've personally guaranteed this, I might come after you. Yeah, maybe you will, maybe you won't. I guess I'll deal with that then. So when you look at SEBA loans, for example, there were about 50 billion of them given out to almost 900,000 businesses. And I don't have accurate stats on this. So I'm just going to make stuff up here, Alan, because that's kind of what I do. But my understanding is that something like 25% of them have not been repaid, which means that's a big number. We're talking, obviously, hundreds of thousands. If so, let's say a couple of 100,000 businesses haven't repaid them. And let's say that maybe only 10% of those businesses over the next year or two decide to file an insolvency. Well, that would be 20,000 filings. There were only 5,000 last year. So SEBA loans alone, even if it's just a small percentage, could cause a massive spike in business insolvencies. Be very interesting to see what happens over the next year or two. But there's a lag effect. It doesn't happen immediately. The SEBA loan repayment deadline was January 18th. We're only just over a month from that deadline. It's going to take many months, maybe even a year or two before the full impacts are felt.
Interesting. You mentioned SEBA loans. I was actually going to ask you about that because I was just going to, I guess, ask you about identifiable trends, right? Are you seeing any identifiable trends that are causing these insolvencies like SEBA loan repayment? Is there things that, you could point to and say, hey, that's happening. Okay, this is what's going to lead to a rise in insolvencies.
Well, I can tell you that prior to January 18th, I got a lot of phone calls from people saying, hey, I'm not going to be able to pay back my SEBA loan. What can I do? And for the last year or two, I've been getting a lot of phone calls from individuals saying, hey, I got the CERB during the pandemic period, and now the government's saying I wasn't eligible. I've got to pay some of it back or all of it back. So all of those are the people who are calling me now. But a lot of those people are not filing insolvency yet because the government is just at the point where they're sending them a letter. They're not taking any aggressive collection action. So the can has been kicked down the road for a considerable period of time, I think. As to what we're seeing, though, we're seeing, everybody's getting into trouble. I talk to laborers, which is kind of what you'd expect, but I also speak to probably one doctor a month who's in financial difficulty. So it's all over the map. And the problem's really simple. Expenses have gone up faster than incomes. So what do you do to bridge the gap? You use debt. And so long as that continues, we're going to continue to see continued increases in insolvencies.
Have you noticed a broader range of Canadian consumers running into insolvency issues? Meaning, are you noticing that perhaps older people are declaring or filing for insolvency versus the younger generation? Are you seeing it more with the older population, or is it a younger population thing, or is it kind of everybody, like you said, is right now in a bit of a pickle?
Well, it's kind of everybody. I mean, the boomers are kind of aging out of it. So they're now at retirement age. Oh, well, I'm not working, so I guess they can't garnish my wages, so I don't have to worry about it. We're seeing a lot more millennials, of course, because they're becoming one of the biggest cohorts and one of the biggest cohorts that's working. But what we're also seeing is people of higher incomes who are filing insolvency. So that doesn't mean they're earning more money because wages aren't going up as fast as expenses. What it means is someone who didn't have to file insolvency last year at that same pay level is now filing insolvency. They're moving up the curve. So during the pandemic years, well, maybe it was somebody who'd lost their job, they weren't working. Now the vast majority of my clients are working. Well over 85% of my clients are employed at the time they file. They're just not making enough money to make ends meet. So the big trend we're seeing is that people of higher incomes are filing insolvency. And I don't have stats to back this up, but I think it's also people of higher credit scores are getting into trouble too. They were able to borrow, their credit score looks good, but they just can't make the payments. So that's definitely a trend we're seeing. People are moving up the income curve with respect to filing insolvency.
I guess it makes sense because you get used to a certain lifestyle, right? When money's easy and free flowing and interest rates are basically zero, and you have access to really whatever capital that you need, you get used to to living a certain lifestyle if you're a consumer or a business in terms of growing the business. And I guess once things start to turn around, and I guess the Bank of Canada and the Federal Reserve in the U.S. they gave us all the indications that this was going to happen. Yet it's very difficult for people then to scale back, right? You get used to a certain way of living, borrowing without even thinking at times. And I guess it just shows that even people that have money, have jobs, they get caught by the same things as those that may not.
Yeah, and I think if you go back 2 or 3 years, the Bank of Canada was saying, well, we're not going to raise, or we are going to. I mean, they did the exact opposite of what they were saying. So, yes, they have telegraphed it, but they don't telegraph it precisely. And yes, you're right. The definition of debt is I spent more than I brought in. That's what debt is. Totally agree. But it's not as simple as saying, oh, well, people have lived beyond their means. That kind of sounds deliberate, like, well, I'm taking 4 vacations a year and that's why I've got a bunch of debt. Sure, there are some people in that case, but the vast majority of people I'm dealing with are going to the grocery store and finding that the things they pay for, food, is a lot higher than it was a year or two ago. And yeah, I know the inflation rate is lower than it was. That doesn't mean prices are down. It just means they're not going up as fast. We had 6 months last year where the CPI was 10% or higher. I don't know of too many people whose wages went up 10% during that 6 month period.
Yeah.
So, yeah, you're right. I'm used to eating food every day. And as a result, that's what my lifestyle accommodates. But as the costs go up, and my income doesn't go up at the same speed, I'm pinched. And that's absolutely what we're seeing. And I think everybody knows that. We all know things are more expensive. If you've got a great job and are making good money, and if you were invested in real estate or the stock market or something, and as a result your wealth went up, you're okay. But the people who were not owners, who didn't own a house, who didn't have investments, those are the ones who really got hammered because their expenses went up faster than their income and they didn't have any assets to fall back on.
So I'm going to ask you to dust off that crystal ball and ask you, do insolvencies, the situation get worse in 2024? What do you think?
Yes. I mean, the trend is pretty well established, and on a week to week basis, I mean, I see the numbers every day, and okay, the first week of February wasn't that busy because the sun was shining, the weather was good here in Ontario, and people were out doing things. But in the last few days, when the weather has turned, it's gotten a lot busier for us. I would expect that we are going to see an increase in personal insolvencies of somewhere in the range of 25 to 30% this year. And that will put us certainly above the pre-pandemic levels. So we will, start to be setting multi-year records again. I don't see any way that trend doesn't reverse. I mean, you look at credit card debt, it's way higher than it was pre-pandemic. So unless we see a massive drop in interest rates tomorrow, which I don't think is going to happen, and a massive increase, I don't know, in the real estate market so that everyone can borrow and pay off their credit cards, I think it's baked in the cake. We will see higher personal insolvencies throughout 2024 and probably into 2025 as well.
Wow, it's yeah, definitely it seems to be going that direction. And so I guess for my last question, trying to leave off on a maybe something on a positive or just some information to impart to those that are watching. I guess my question is, what should businesses and consumers do when they see signs of trouble? Do people often wait too long before they actually, uh, do some sort of intervention? What could people do to mitigate what is happening? Their costs are rising, their incomes are not rising at the same level. At what point should they then say, wait a minute, we got to stop what we're doing? And what advice could you give individuals to kind of say, hey, this you're going down the wrong path. We need to make a change here.
Well, debt does not get better on its own. Compounding interest, if you've got assets, it goes, it's great, but it goes the other way. You can get into a hole really quickly. So don't wait. It's exactly like with a medical problem. If you've got a medical problem, probably waiting 6 months is not going to make it better. It's going to make it worse. So if you are experiencing debt problems, if you're a business, obviously reach out to your accountant, your lawyer. Maybe there's some cash flow things you can do and so on. And if you're a person feeling that same pinch, then the person you want to talk to is a licensed insolvency trustee. We're all licensed by the federal government. You don't want to follow some guy on Facebook who just put up a page yesterday and says he can settle your debts for 20 cents on the dollar. And no, you want to deal with a reputable professional. There's no cost to meet with us up front. So the sooner you talk to a professional and understand your options, the more likely you are to be able to come up with a plan and get a fresh start.
Well, great advice, Doug Hoyes, licensed insolvency trustee. Thank you so much for being with us this afternoon, giving us some great information, great tips at the end there for those that might be going down that path, unfortunately. Once again, thank you so much for coming on the show.
Thanks, Alan.
All the best. Talk to you soon. Bye bye.